In this chapter, we're going to introduce the topic of risk. How do we measure the risk of a company, of a project, in this capital budgeting environment that we've been talking about for the last couple of videos? So, what is risk? It's the uncertainty about future profitability. Right? We are estimating cash flows into the future. By definition, that is risk. So how do we measure this? We can measure it by the standard deviations of either net present value or the internal rate of return, or we could also use beta. So the question we want to try to ask and answer is, will taking on this project, will that increase the firm's and or the stakeholders' risk in the company? So is risk based on historical data or subjective judgment? Sometimes we're at least going to start with historical data, but generally we can't rely on historical data. So risk analysis in capital budgeting is essentially based on some subjective judgments. There are three basic types of risk in capital budgeting: standalone risk, corporate risk, and market or beta risk. So standalone risk, this is the project's risk if it were the firm's only asset and there were no shareholders. This type of risk ignores both firm and shareholder diversification. Essentially, it looks at this project, as stated here, as standalone. If this project was out there and you were just looking at that project, what is its risk level? And we can measure this by either the standard deviation or the coefficient of variation of either net present value, internal rate of return, or the modified internal rate of return. Now, corporate risk reflects the project's effect on corporate earnings stability. So it looks at the company's other assets. So this is really looking at diversification within the company. So it depends on the project's standard deviation and its correlation with the returns of the other company, the firm's other assets. Typically, we're going to measure this using the project's corporate beta. Market risk. This reflects the project's effect on a well-diversified stock portfolio. So this is looking at stockholders' other assets. So this depends on the project's standard deviation and its correlation, and the correlation between the project and the stock market. So again, this is measured by the project's market beta. So we have three different kinds of risk. We have the measurements for each kind of risk. So what is it that we use? So market risk is theoretically the best risk in most situations. But this ignores creditors, customers, suppliers, and employees. They're really more interested in corporate risk. So corporate risk is also relevant when you're considering projects. Now, standalone risk is the easiest to measure. It's more intuitive. So core projects are typically thought to be pretty highly correlated with other assets. So therefore, its standalone risk generally reflects corporate risk. So if the project risk is highly correlated with the economy, though, it also reflects market risk. So what are we interested in? What is the best thing to do? Essentially, standalone risk, since it's the easiest to measure, that is typically what we're going to use as long as it is highly related to the company's other assets. So how do we measure risk then? Well, the first thing we want to look at is sensitivity analysis. So what is sensitivity analysis? We actually used this in a previous video when we talked about the net present value profile. In this case, we're going to look at changes in net present value or the internal rate of return when we change a single variable. So everything is fixed except for one variable. So this type of analysis answers this question. What if? What if sales decline by 30%? How will they influence the value of this project to the company? So we can calculate then. Here we have an example. We have the net present values that are calculated, right, based on changes. So if the unit cost changes, if it goes down by 30%, what would happen in net present value? So hopefully you notice, so what if costs go down, value goes up. So this makes sense. So we're going to calculate net present value with these percent changes. We'll also do the same maybe for unit sales. Also do it for salvage value. So essentially we're getting a picture of how net present value changes relative to each one of these variables. And quite frankly, we should do this for every single variable that's in the project, right? Maybe we also want to look at inflation, right? How does net present value happen if the price inflation changes? If the, again here, unit cost changes? What if one of the unit costs is petroleum, right? Oil. So what if the price of oil changes? How does that affect the cost of the unit and then therefore net present value? So what we'll end up with is we'll end up with these net present value kinds of relationships. And you see here as the cost increases, we see that the value, net present value, declines. As over here, as the number of units sold increases, we see that the net present value increases. So what is it that we want to know from here? The steeper the sensitivity lines show greater risk. So that means that small changes will result in large changes in net present value. So the cost line in this graph was the steepest, and the sales line is also steep but not quite as steep, and salvage is flat. Right? So if you look here, which one of these, they're a little bit, this is just a little bit steeper than this line. So we need to focus on the costs and the sales demand because we want to put all of our research money in those variables that are the most sensitive to our decision. So quite frankly, whatever number we come up with salvage is almost irrelevant because the change in net present value doesn't change much at all when we change the salvage value. So what's the primary weaknesses of sensitivity analysis? It doesn't help us with diversification because it's really looking at standard deviation and the changes in this one particular variable. It doesn't talk about the likelihood of change of a variable, right? It doesn't give us any kinds of estimates of whether or not this particular change will happen. And of course, since it's in isolation, we're not combining things. We're only looking at what happens with one variable. So why is it useful? It gives us some idea of standalone risk. It identifies some dangerous variables that we want to be careful with, but also gives us some ideas of break even. So what's another technique that we can use? Scenario analysis. Scenario analysis looks at possible situations and looks at what we would refer to as worst case, most likely, best case. So this provides a range of possible outcomes. Now, what this also does, it requires us to forecast the outcomes, the net present values, etc., under each one of these conditions. So it was going to require some work. So in this case, we say the best case scenario, we're only changing one variable here, is if we went to 1,200 units at $240. The worst case scenario would be 800 units at $160 as the unit price. What you see is we end up with net present values based for each one of these, and we have to have a probabilities. What's the probability? Sales will be $1,200. Unit price will be $240. Net present value, then, there's a 25% chance of $227,595. Okay, so this is very similar. In fact, it's identical to the analysis we did with standalone risk when we were talking in the risk chapter and risk videos a while ago. So this will calculate our expected net present value. If we do this project, we would expect $72,000. The standard deviation is $103,000. Coefficient of variation, 0.7. And of course, the range here is this 290. So again, what we want to look at here, what we're trying to explore are the risk fundamentals, right? Those fundamental concepts of risk and return. The exact average returns, standard deviation. Now, one of the things that we could do is we could create the confidence intervals. What's the confidence interval of, say, 90%? And we had a formula of that a little bit earlier. How do you calculate those confidence intervals? And this can help us maybe see, well, how bad do things have to get before we get to a zero net present value? So again, this is just a way, a methodology, if you will, of looking at standalone risk. Are any problems with this? Of course, what they say here, it only considers a few possible outcomes. So we could expand this. So maybe we do 5. Doing 20 or 30 makes absolutely no sense. There's way too much work for that. Statistically, you don't gain much from that. But if we could maybe increase it from 3 potential things to 5, that might help us a little bit, at least with this one assumption. It also assumes that all the inputs are perfectly correlated. That means they're all the bad things are going to happen at the same time, all the good things are going to happen at the same time. Again, this focuses on standalone risk. We may also, remember we talked about this, we still may want to make some subjective adjustments to this particular kind of analysis. Look forward to seeing you in the next video.